Hi everyone, welcome to this live webinar where I want to discuss the best investment opportunities at the moment. And you should all be able to, me telling you the ones which have just risen in the past week. There's 9,000 odd stocks on the on the US markets, the UK markets, and international stocks listed in the US markets, like Alibaba, for instance, or Infosys, or whatever. So it's all very well saying, well, there were 11 which went up over 100% in the last 5 days. How the heck are we going to pick them from this massive list of about 9,000 that exist out there? How do we narrow that down? How do we filter that? What should we look for? What might give us an edge? And also, we don't want to be chasing our tails. We don't want to be not a long-only retail fund manager. None of our funds are available to the retail client because they're hedge funds, and so it's actually a criminal offense to offer those to retail clients. And I don't have any long-only funds, retail funds, okay? So we've got no conflict with you. I'm not a broker, so I'm not trying to get you to trade through my brokerage either, okay? So there's no conflict of interest with you. My background, I used to be a retail investor, so I used to be a trader as a retail trader, and then I set up my asset management company. We now have various funds in private equity and in hedge funds, and there's our little offices. I want to show you here. It might be a little bit difficult to see. All this says is, we then think to ourselves, wait a minute, is the market at an all-time high? So we come out of the market a little bit, and what happens? We miss just one or two of the big trading days, and boom, guess what happens? If you miss just the 5 best trading days over in the last 20 years, just the 5 best trading days, you'll have generated 50% less gains in your portfolio. The networks. Let's just go to our financial goals for a second. Assume you plan to invest for 10 years. And with a bit of my help, and of course the market really, it's not me who gets the returns, it's the companies, it's Square or Tech Target or Trade Desk or whatever that generate returns, not me. I'm not doing anything, I'm passive, okay? Might be MedSpace. You might think, who the hell are they? Well, I'll tell you some of the stocks I may or may not like at the moment, right? It's them doing the hard work, not me. Okay, so I can't take credit for it. And you, with my help, let's say you make 20% per annum. Now, for my global picks, I want to make 40% per annum. And you might say, that's a bit ambitious. Have you looked at what the hell's going on with stock returns? 40% is not ambitious. If anything, it's probably a bit unambitious in the current environment. Okay, it's not me doing it. It's the market. It's not like I'm some superhero. It's them working hard. They're cleverer than me at those various companies. All I did was put a bit of capital in their way. Great, it's the easiest bloody thing you can do. I hit an enter key and took the credit for all the hard work that the companies I put the money in did, right? I'm a man, I'm bound to take credit for other people's work, aren't I? And with my help, let's say you make 20%. Some years you might make more, some you make less. So let's be a bit conservative. With my UK picks, I'd only expect to make 20% because the UK markets tend not to rise as much as the US ones. And let's make this other point. I'm British and very proud of it. I want British people to own global stocks. I want them to have Johnny Foreigner working for them, making them lots of money, and then repatriating that money into Britain and spending it at their local Aldi and Poundland and Sainsbury's and Harrods, okay, whatever your sort of particular place is. And the government does as well. That's why it allows in your SIP and ISA foreign stocks, because it wants you to have a comfortable retirement. Okay, and these tax-free savings. And the great news with this is the younger you are, and there's some 20-somethings in here as well, I know, watching this, the younger you are, the better and easier it is to make those returns. You can also plan, let's say we're doing this. Let's say you start with 100K, and you're going to say to me, Alpesh, we're not on 100K, okay? You're not in, we're not on 100K. Well, I'll do the smaller example later. So the 100K is probably somebody in their 40s, 50s, 60s, obviously. I'll do a 10K version, which is probably somebody in their 20s, maybe 30s, right, in just a second. And let's say you plan to add 1,500 each month. Divide everything by 10, by the way, if you've got less. Okay, well, you'll have 1 million in 10 years. So you go from 100K to 1 million in 10 years on that. Okay, what does it look like? It looks like this. The blue line is your contributions, because you're obviously going to add some. You're not just going to say, I'm never going to add to my savings ever again, right? And in 10 years, you go from there to there. Now, what's interesting about this? Well, first of all, it's taken 20% as an example, okay? And you'll see it accelerates as time progresses. So the really juicy part is really years 6, 7, 8, 9, and 10. These early years seem a bit slow. They're the years where you're tempted to take your money out and say, oh, it's not really doing anything, darling, let's go on a holiday instead, right? Actually, that's where they have the impact at the back end, right? Then it just starts getting crazy, right? Well, let's say you don't have those numbers. Let's assume you only have 10K to start with and plan to add 6K a year. Maybe you'll put 500 in a month. Then this is what your return looks like. And let's say because you only started with 10K, you're going to take longer over it. You're going to look at 15 years. Okay. Well, and this is what my son's looks like, because his is in an ISA. So he starts off with less money because the ISA maximum is smaller. It was 4K when he was born. And I think last year it was nearly 10K. And so he's about here. And you might think, well, it's not much more than the contributions you've made, Alpesh. Not great. Yeah, because by the time he goes to university, the spoilt little brat will probably have about $500,000 or pounds, because you can convert this into pounds. It's, you know, the maths are still the same. £500,000. Well, I wouldn't have minded that. I didn't grow up with a silver spoon when I went to university. I had to be on a full grant. I grew up in, I'm born and raised in Leeds. So the biggest worry I want to have when my son goes to university is to make sure the brat isn't spoiled. He's a lovely kid. He won't be spoiled because I'm a Yorkshireman. He definitely won't be spoiled. But my point is, right, how do we do that then? Now we know what the goal is. Tell us, show us the names, show us the stocks, right? Part one, problems investing now, which will take me 5 minutes. And then part two, let's look at the stocks. What are the solutions to our problems about investing? Which are the stocks I like, Goldman likes, Buffett likes, the names, and how do we pick them? All right. Now, here we go. Let's look them over. What are these great stocks? First of all, problem number one, there's too much information. So we're going to remove it. We're going to simplify it. Of course, we all know there's a multitude of ways to value a company. There's price to earnings, price earnings growth, price to book, price to sales, discount cash flow. How the hell are we supposed to value it? Which one of those do we pick? Which one of those do we know is important? Which one isn't important? And the value of a company, i.e. its share price relative to the cash it generates, or the value of its assets, or how much its profits are, or how quickly its profits grow. Those are all different valuation factors. Surely somebody's done some analysis somewhere which tells us some things are more important than others. But wait a minute, don't overvalued companies still keep growing, and don't undervalued companies sometimes go bust? So valuation can't be the only metric, can it? No. We know growth in terms of sales of a company, or earnings, which means profits, or even cash flow, which is not even profits, it's just cash. Is that important? How important is that? Which one of these factors is important? Thankfully, there's been ample research done on this. What about dividends? We know companies which pay dividends tend to, as a general rule, there are exceptions, as a general rule, do better than companies which don't. But is that the only factor we should look at? Of course not. We also know some companies just run on momentum, just the trend alone, noise. But we also know that if we follow that, we're going to get wrong-footed and fall off a cliff. So how much weight do we give to each of these factors? And what about the fact that all stocks are they're just share prices? If they're prices, why don't we just look at the distribution of those share prices? If something just consistently goes up every single month and every single year, why don't we just back that? Who the hell cares about its earnings, its growth, its income? You just look at its share price. It just keeps going up every single month. Let's just ride that distribution. That's statistics. How important is that? And what I'm going to suggest to you, and based on my research and what I'm going to show you from what I've written in all my books and in my Financial Times columns. Don't forget, everything that I'm saying to you has been published in my Financial Times columns as well, is this. We have a strategy and we have tactics. And this is why people don't make money. They get these two mixed up. And I'm going to show you what the strategy should be, and then you can pick whatever tactics you want. Strategy is, yes, we're going to look at valuation, growth, income, cash flow, outperformance of a company, and the volatility of its share price. We want volatility to be low and want our performance to be high. We want cash flow to be high, dividends to be high, revenue growth to be high, and valuation to be low. Why? Because we don't want to be gambling on, oh, the market now wants growth companies. Now it wants momentum companies. Now it wants undervalued companies. We're not gambling on that. We're not gambling on news. Why? Because that's higher risk. We don't want to be speculators. Let 90% of everybody else do that, because we have got our eye on the prize. We want our 40% per annum, or 20% if we're only looking at UK stocks. There's no reason to do that. But even if you missed your 40% and only got 20, you saw you were still getting rich over a period of time, and you were sleeping easy. Okay, so we want to tick all of these. As long as the stocks hit our strategy, I don't care what tactics within there you might use. Now, the tactics you might use is you might say, well, I want some smaller cap companies. By the way, at the moment, tactically, I do want some smaller cap companies because within this overall strategy, I believe the smaller cap companies like the Russell 2000 companies will do better. But that's tactical within this strategy. It has to be within this strategy. I might say I don't want to be too heavily loaded on NASDAQ companies because they did so well last year. There's going to be a shed load of profit taking. So I want companies from other sectors. That's tactical within the strategy that they've still got to meet my value, growth, income, cash flow, outperformance, volatility factors. I filter. It's a bit like interviewing candidates. They've got to have won the Nobel Peace Prize. They've got to have got a PhD from Oxford University. They've got to have a track record of just being amazing everywhere they go. Great references. Now, within that, if they've got blue shoes or black shoes, I don't really care. You know, what color, you know, whether they're male or female, so I can level up the numbers. Yeah, tactically, I might say we need a woman now because we've got too many men. We need an ethnic minority because we're disproportionately underrepresented. But that's a tactic within the strategy. They've still got to be meritable and be within the overall strategy. So we're going to look at strategy in a second. Geography. I do want more UK companies this year because I think we're lagging. But out of my stock, I'd probably say only about 15% are going to be UK. For instance, I own CMC Markets. Volatility. I might want slightly higher volatile companies within the overall strategy because I want to take more risk, but that's my risk appetite. I might want some of the big gurus, and I'll come to that in a second, and the analysts at the banks quite like, or fit the news. Well, that's just nice to have, but that's tactical. Within the strategy, it's got to sit. I.e., do they tick all these boxes? And then if the news is nice, great. The mistake most people make is they start with the tactics and then they try and find a company. So they go, what's in the news? Oh, I'll buy this company. They haven't looked at the valuation, the growth, the income, the cash flow, the outperformance, or the volatility. And then they wonder why it falls like a dog. Okay. You and I know markets can only do two things. They can either go up or they go down. We want the kind of stocks which when the market goes down, ours don't fall as far. When the markets go up, they go up further. Right? What you might call square root companies. Remember what a square root looks like? Okay. We want companies which don't fall as far when the market falls and rise more when it rises. Well, what kind of characteristics do you think those kind of companies have? Do you think they have relatively good valuations to their profits? You better bet. Good growth. Yeah. Income, cash flow, outperformance. It's the fact that it's not about how much money you make when the market's going up. It's how much you get to keep when the markets are falling. And we want the kind of companies which when the markets fall, don't fall as much because they've got that cushion of outperformance, cash flow, income, growth, value, right? Beyond that, tactics, I don't care what sectors you pick and so on. Okay, so like I said, the secret to success in the markets, I'll name some more names in a second and how you find them as well, but I'm giving you the theory of it to get you into a level of expertise. Companies which fall the least in down markets and around the most in rising markets. Everyone is a genius in rising markets, all right? Everyone's a genius, including me. We're all geniuses. It's not how much you make, it's how much you get to keep when the market falls. Companies which fit the above a few, approximately 10%, they're strong on profit growth, dividends, cash flow, consistent sales growth, fair valuation, and outperformance. And it's not me who's just making this up. In actual fact, the people who advise the wealthiest, richest people on the planet, this is stolen from Goldman Sachs. Guess what they do? Oh, we look at management quality, sustainable leaders, industry positioning. They're just saying exactly what I've said. And we look at return on capital and this formula. Croaky, I'm going to come to that because I've stolen that from them. And that generates 30% per annum. And I'll show you their slides. So you don't have to take my word for it. Their slides on that. And everything I'm telling you, I've published in my columns and in my books, just so you know that. All right. I don't want you to think, oh, well, he's just pulling this out of the air. Not only that, all of it has been monitored and regulated and all the rest of it by Financial Times award-winning companies, independent of me. And they've been doing it since 2004 when I'd been offering it and giving the data to them. All right, in terms of my picks and what my ideas are. So I've been double, triple, quadruple probed, as it were. All right. And I don't have a problem sharing it all, let alone the fact that I'll talk about it on. Now, I've been accused of being full of myself. I'm not trying to be full of myself. I'm all right. What I'm trying to be is to make sure you know that it's been vetted, and you should know anything. What anybody says on the internet is vetted. So please don't confuse my evidence to show credentials as being full of myself, as somebody once said, right? So let's get to it. What are these strategies from these various sources and places? Now, the first thing I want to say to you is this. On the whole, by having stocks, this is your portfolio risk, okay? This is your portfolio risk. This is your market risk. You can't diversify away market risk. What I mean by that is when the market falls, everything falls. Costco and Microsoft fall together. Okay, Microsoft does fall. It doesn't just keep going up. This time last year, it fell about 25%, and that's probably the safest company I can think of. You might be able to think of safer companies than Microsoft, but I can't. Okay, so my point is this. I think once you've got about 15 to 20 stocks, you've pretty much diversified most of market risk. So all those people who want to defend fund managers for having 100 companies and putting a tiny bit of your capital into their 98th company because they get broker kickbacks, you go ahead and defend them all you want. There is nothing I can say to persuade you otherwise. You go and be an apologist for fund managers putting away your pension fund, okay, on their boats and yachts. Go ahead. But all I'll tell you is if you're picking your own, you might want to look at 15 to 20 picks. If you're really worried, maybe 30. I'd probably say, don't take my word for it. Just look at the data on it. Once you get past 40, and you might say, no, Alpesh, this is wrong. What if they're all in the same sector? Well, data shows that companies on the downside are highly correlated regardless of sector. When the markets fall, when we need diversification the most, we don't get it. We don't get it across geographies or sectors or market cap. Yeah, when the markets fall, Chinese companies fall just like British and American ones do. When the markets fall, retail companies fall at the same time as software companies do, I'm afraid. And the data shows it. I wish it didn't, because it'd be easy then to make money. I'd just have a bit from everywhere and be well diversified, right? Now I can send you the data if you really want to know and get a PhD in the subject. Okay, so for me, the markets can do one of two things. They either go up or they go down. So I've got my 15 to 20 companies. Now I have 5 companies which I consider quality companies, and I review those every 12 months. And then I've got the rest which are performance companies, which I review every 12 months as well. I'll tell you what my 5 quality companies are in a second. By quality, what I mean is if the world comes to an end, they're the ones where there'll be a flight to quality. They have got so much cash in the bank, and yet they grow that they still give me upside returns, and if the market falls, I still get a good night's sleep because they won't fall as far and they'll rebound more. That's my 5 quality companies. The rest are performance. All are reviewed after 12 months. Okay, so I don't buy and hold everything forever, and I'll tell you why 12 months in a second. Equally, if the market falls, well, my quality companies I still hold, but with my performance stocks, if they drop 25% from the highest they've been since I bought them, within that 12 months, I exit. And if 12 months are up, then it's time to review anyway. Why 12 months? Let me share that with you. Now, whilst I might get data, because obviously as a hedge fund manager, guess what? Goldman Sachs, UBS, they all send me lots and lots of information because they want us to trade through them or give them capital and all the rest of it. Or they want us to do what they're doing so that it becomes a self-fulfilling prophecy. March the 26th, 2020, they sent an update on coronavirus. That was pretty much the bottom of the market. And Goldman Sachs had pretty much said, we're going to start buying. Now, I'm not gambling on what they say. I'm not gambling on any inside information. Don't have it. It'd be illegal anyway. It is something which goes into the pot. I still have to look at the strategy, value, growth, income, cash flow, momentum, okay, outperformance, all of those things. And I'll explain how we get those in a second, Maz, my friend, in a second. The other problem you've got, so we're going to do problems first, then we'll do the solutions, is your fund manager, right? And this is the problem with your fund manager. I want you to look at what you've got in your SIP and ISA or your savings and your desire to give it to a fund. And they have to give you what's called a key information document. I want you to drill down on that. And I want you to look at why the hell have they got over the last 3 years. This is a typical fund one of my students had. Okay, 91 UK, listed equity growth. Listed equity growth fund, down 2.3%. Down 2.3%. They've got 8 out of 10. They've got all these diamonds. They've got a letter A. It's all marketing, I'm afraid. Okay, all of these, okay, have got, these are marketing gimmicks. How are they marketing him? It's because over the last 3 years, he's down 2%, and the US stock market is hitting all-time highs. Well, of course, because he's only invested in UK equity growth. Why? Why are you picking from a narrow gene pool? I mean, that's just racism. Okay, and it's fashionable to call everything racism, but you're just saying, I'm only going to pick UK companies. What the hell's wrong with you? Why would you do that to yourself? Why would you not say, I want the most talented people in the world generating a return for me? And this is taken from that fund manager. Pick any fund, and this is what they'll tell you. Moderate scenario, what you might get back after costs. Average return per year, let's say you get 5%. What you'll get back after costs will be roughly about that. Average return per year. That's what they're telling you. After costs, we'll give you back 5% per year. Barely more than a high-paying bank account. 5% per year? Get lost. You know why? Because the fat fund manager's getting the rest. Okay? Top holdings. Let's look at their top holdings. This is why I'm telling you to do it. And by the way, those of you who say, no, what about passive ETFs? What the heck do you think passive ETFs are investing? They're just fund managers without the fund manager. They're still doing the same investments. They just got rid of the fund manager and got a computer instead. Same investments. Okay, so here you've still got the same problem. The fees are lower. That's all. Top holdings. BP. This is before the oil price crash. This. All right. Shell. Before the oil price crash. Called it a UK growth fund and put it in tobacco. Look, excuse me, but I didn't realize tobacco was a growth industry. I thought people are smoking less than ever. Right? 48 stocks. And they're all in the largest UK companies. No wonder he's down 3%. That's your pension. That is a typical fund in a typical pension. Look at your own. Go ask. Or look at the fund you're looking to invest. They've got to give you that document. When you look at it, you'll think to yourself, oh my God, what the hell? Why the heck have I given them that money? Okay? And here's worse. Here's the kicker. For all of you who think, yeah, but obviously they only charge 0.5% per annum. No, you've been lied to. Look, this is their own document. Investment, £10,000. Scenarios. If you cash in after 5 years, recommended holding period, £1,000. Total cost, £1,000. 10%. But Alpesh, it said 0.5%. I'm sure somewhere I read 0.5%. Look at their entry charges. Look at their exit charges. Look at the total cost of ownership, the compliance charges. All the other charges, the brokerage charge, look at everything, right? All the small print. I used to be a barrister, so I'm used to looking at small print. That's their figures, 10%. Every 5 years, you're giving away 10% of your capital to the fund manager. No wonder everybody's dying to be a fund manager. No wonder. Jasminder's asked, can you hold a SIP and ISA at the same time in the same tax year? Yes, Jasminder. My friend, we better speak. You're worrying me. Because if you don't know that, then you've been missing out on great tax-free returns, or at least tax-mitigated returns. And it worries me. It's not your fault, my friend. Nobody teaches you this at school. Nobody tells you you can have all these global stocks to choose from in your ISA and your SIP, and you can have a SIP and ISA at the same time, and you can use the same broker to do it. Nobody ever tells you this. Why don't they tell you? Because they don't want you to be informed, because they want you to go to, guess what? A fund manager. Because there's an issue there. Problem 4, when to sell? It's not a problem. It's not a problem at all. I've just told you. 12 weeks, or if the market if your stock falls 25% from the highest it's been. Harper, shouldn't there be more complicated rules than that? You can if you want, but don't make it more complicated. One of the reasons is this chart from Goldman Sachs. Basically, what this is saying is 12 months is a pretty good period to be holding equities. It's the period over which the fundamentals apply. Now, we can argue the toss later on, but we haven't got the time. 12 months is what we should really have. Interactive investor, Sean said, we got all of that. Banks are telling their richest clients. Again, it still has to be value, growth, income, okay? Value. Personally, investing is like learning to drive. When you drive, you've got a steering wheel, rear view mirror, wing mirror. You've got brake, accelerator. Well, you've got, with investing, cash flow, valuation. All right, valuation, growth, income, cash flow, momentum, right? You've got Sortino, which is a measure of the average return versus the volatility. You've got alpha, which is outperformance of the market. All the factors I've talked about. Now, tactically within that, I might look at higher volatility because I want higher risk. I might look at companies from different sectors, but strategically, it has to fit within that. That's my holy grail. Within all of that, okay, the important factors are like I've told you, global in outlook, not racist to a particular country. I know that sounds funny, but it sort of gets the point across. Monitor infrequently. I'm not looking at this every day. I want to have a good night's sleep. They're investments. They're not trades. You never trade your investments. Otherwise, remember what happens? You mistime it. The market shoots up and you missed it. Now, look, I'll give you an example. I own PayPal. I suspect, and this is, I'm going to be incredibly honest with you. I own PayPal. I suspect it's going to fall. It is more likely to fall in the next month than rise. So you might say, why the hell do you own it then? Why don't you trade out of it? What's wrong with you? And the reason for that is, guess what if it rises? Equally, I don't want to trade my investments. If I trade that one, I've got to trade all of them. And I'm holding it for 12 months and probably the next 12 months after that and the 12 months after that, I suspect. So I'm not going to try and worry over a week or even a month over that period. It's a bit like, let's say you own a house and somebody says to you, next month house prices are going to fall. Do you go and sell it and rent and then go back again and then go back and forth? No. Why don't you do it with a house? It's exactly the same reasons you don't do it with stock, okay? It's exactly the same reason.